I think the biggest surprise for us has been the resiliency of the U.S. economy and U.S. credit markets. And what's been notable is that higher interest rates really haven't translated to a material tightening in financial conditions that slowed the economy or created volatility in credit markets.
One thing that surprised us in 2024 has just been an overall lack of volatility. For the most part, spreads have just grinded tighter throughout the year outside of a couple of blips, and it's been a pretty consistent move tighter. So despite the fact that we have had some overhang with the election, we have had some volatility in rates, and we have had other geopolitical risks, corporate spreads have been remarkably resilient, and our market has, for the most part, outperformed throughout the course of 2024.
I was pleasantly surprised at the growth of the private credit market in 2024, spanning both investment grade and non-investment grade portions of the market. Year-to-date 2024, we've seen the investment grade private credit market grow by over a third, and this growth was fueled by a relatively new area of the market, especially finance.
What surprised me most about 2024 was the consistency of themes throughout the year and how that drove markets. We started 2024 thinking we were going to get the first half of U.S. resilience, U.S. growth was going to be strong, and rest of world growth would continue to be somewhat stagnant, mostly Eurozone and China, the other two big drivers of global growth. But what happened throughout the year was those just continued through 2024, and that's what really drove markets throughout the year. We saw U.S. growth surprise above consensus for both third quarter, and it's on track to surprise for the fourth quarter as well. And Eurozone and China continue to just kind of muddle along around trend growth, maybe slightly below that. Now, we've seen signs of stimulus out of China. We expect 2025 might be different, but the consistency of those themes throughout 24 really surprised us.
Coming into 2024, there was an expectation that there would be volatility associated with a huge election year, and this was emerging markets and developed markets. In the emerging market space, we saw big elections in many large core emerging markets. Starting right at the beginning of the year with Taiwan, that was an expectation we could see some volatility related to China out of that, and we really didn't. And then moving through the year, we saw markets sort of shrug off. You know, we had elections in the first quarter in Indonesia, local elections in Turkey. The markets really took this in stride. Second quarter, with the big elections in India, Mexico, and South Africa, there was a little bit more volatility as we awaited outcomes, but then when we saw really the markets normalize around that, with the exception of Mexico, where we're still looking at it. And then, of course, when you add on top of that some of the volatility around the developed markets, you add in some geopolitical risk and the uneven growth in China, you know, we could have seen some spikes in volatility, but we really didn't. And I think this speaks to the resilience that we are now coming to almost expect in emerging markets.
One of the things that surprised me in 2024 was the increased use of liability management exercises within the high yield market. It seemed to become more of a commonly used tool by investors, and the markets actually adopted it pretty quickly. I think the landscape's changed. Traditionally, it was something that a corporate would use to help defend itself against investors, whereas now as investors are using these liability management tools to figure out ways to extract value from the company and also extract value from other investors.
One of the biggest surprises in 2024 to me was the resiliency of the consumer. GDP was once again very robust, and this occurred despite the fact that the yield curve remained historically very flat.
I think in terms of things that surprised me in 2024, the performance of floating rate borrowers, the resilience of the commercial real estate market, and the resilience of the housing market. All of these things have quite a bit of sensitivity towards interest rates. And given the raising rate cycle we've endured, the performance of those spaces and the lack of any significant distress was a surprise to us throughout the year.
I was surprised by the strength of the labor market in 2024, which contributed to a productivity-led growth without fueling inflation.
So one trend that we noticed within the leveraged loan and high yield space was just the outsized amount of issuance that we saw in leveraged loans, both in absolute terms and also relative to high yield issuance. So for context, if you look at what expectations were heading into 2024, many analysts across the street thought that high yield issuance was actually going to be higher than leverage loan. And actually what we saw in practice was that the leverage loan issuance went up about threefold, whereas high yield issuance was up about 50% on a gross basis. And then if we look in net issuance terms, high yield was about flat over that 2024 period, while leverage loans was up about 100%.
Just to add on to Scott's comments, the trends he was noting in 2024 are something we've seen over the past several years. That is, growth in the syndicated bank loan market in terms of issuance has outpaced high yield by a pretty wide stretch. So much so now that the syndicated bank loan market is bigger than the high yield market. And a lot of the issuance that we normally would see coming into, particularly the lower quality coming into the high yield market, is actually showing up in the bank loan market. Now you look at those two indices and they look a lot alike in terms of average quality and return and risk profiles going forward. And we think that's something that will continue as we move ahead in the Lev Fin market.